Welcome to Money News. I'm Kathleen Walter. With us today is the former chairman of the FDIC and the senior managing director of FTI Consulting, Mr. William Isaac. And Bill, thanks for joining us today.
Great to be with you, Kathleen.
Well, there's been a lot of fear and speculation about just when and by how much the Federal Reserve will start tapering its quantitative easing program. When do you see the central bank beginning to taper, and what effect will that have on the economy and on the stock market?
I am hoping that they will begin tapering sooner rather than later. In other words, yet this year. And I also would add that I've never liked QE. I think it's been very harmful to the economy and normalizing things. Keeping rates so low has been very hurtful to retirees and their ability to spend money. Or even retire. A lot of people are staying in the workplace that really would be retired if they could get a decent return on their money, and opening up jobs for young people where the unemployment rate is so high. So I really think that QE has caused all sorts of distortions in the marketplace, and we would have been better off without it. I have no problem with the Fed having supplied a lot of liquidity during the crisis, but I really believe that its interference with the markets since the crisis abated has not been helpful, has done more harm than good. And
what about growth in the long run? Do you think the Fed's tactics will harm growth in the long run as well?
I think they already have. I believe that businesses are not making investment decisions. Consumers are not making spending decisions because they really don't know what to predict for the future. They've never seen fiscal policies and monetary policies like we have today, and it's very hard to determine what's going to happen to the economy, what's going to happen with inflation, what's going to happen with interest rates, and people really there's so much uncertainty. People are afraid to spend and or invest, and I think that's happening. I think it has retarded the economy. We should have had a faster recovery than we've had. And there's no way to prove that. I'm just, people will argue both sides of that issue. I'm just giving you my opinion. It has been hurtful to the economy more than it has been helpful.
Do you see the economy contracting? I mean, U.S. jobs data came in stronger than expected, but before that, some data appeared weaker, and some economists were lowering their estimates for the second quarter. Are we in for a period of contraction now, or just stagnancy, or just slow or moderate growth?
I wish I knew, but nobody does. I would say that I'm not impressed with the employment number. 195,000 jobs, as I believe, were created. We need to be somewhere around 300,000 jobs a month for the unemployment rate to come down, and we have a large number of people who are in part-time jobs that would like to have full-time jobs. We have a lot of people who've given up working that really would like to work, but they've taken themselves out of the labor force. The rate of participation in the labor force is way too low, and so I'm not impressed with where we are. I think it's a period that reminds me of the late 70s, where we had stagflation, no growth, and inflation kept on creeping up. So far, we haven't seen a lot of inflation, but I don't rule out that could happen. I think there are higher odds we're going to have inflation than we're going to have deflation.
Mm-hmm. U.S. stocks recently had been on a record-setting surge, but then seemed to hit a speed bump. Do you think that the market will continue to set more record highs, or is it poised for a fall?
I don't know. I don't understand why the market's up as far as it is, except that the Fed put interest rates so low that people really didn't have very many alternatives for their money. I don't understand what caused the market to go up from 10,000 to 15,000, other than Federal Reserve policies, the QE 2 and 3 and all that. I don't understand why the market made that big move, other than the fact that there weren't any alternatives, and so that scares me when a market is being artificially impacted by the actions of a government agency, actions that can't continue forever. So concerned. I don't trust any markets right now because of the fiscal and monetary policies that we've never before witnessed, and we know they can't continue. We can't keep on spending the kind of money we're spending, and the Fed can't keep on pumping up its balance sheet the way it has been. And so it's really hard to predict where things go. And I know everybody would like to hear a good, solid prediction, but I don't know how you make one, because we're doing things we've never done before, and we know they can't continue forever, and we don't know what happens when they end.
Last question for you, Bill. The IMF has cut its global economic growth forecast, citing new downside risks in key emerging market economies and a deeper recession in the Eurozone. I know you say that things are tough to predict, but what effects do you see this having on the U.S. economy?
Well, I actually would agree with what you just reported the IMF as having said, that things do seem to be slowing down in the developing countries. I'm not sure what category I'd put China in, because it's already pretty developed, but things are slowing down in China and other countries, and Europe is in a deeper funk than we thought and or expected. That has to impact the U.S. If those trends continue. We are not an island unto ourselves. We will be impacted by that, and it will be negative. So I do think that now is a time for people to be cautious with their money. Just be careful where you're putting it.
All right, former FDIC Chairman Bill Isaac, as always, it's good to have you on Money News. Thanks for joining us today.
Thanks, Kathleen. I enjoyed it.
And thank you for watching Money News.